welcome to this quick dive into Upper Manhattan. Haley, Jake, and Seth.
Thanks for having us.
Yeah, awesome.
Yeah.
So, as we do these little vignettes into each submarket in the city, they're all different. They all have different characteristics. Seth, start us off. What is uniquely occurring for owners in Upper Manhattan right now? Like, what are some things that you're seeing that are specific to that neighborhood?
I think it really depends on which pocket of Upper Manhattan we're talking about. There's probably like 3 or 4 different subsections. Really just north of 96th Street, you have the area near Columbia and west of Broadway and even west of Amsterdam, where you have a very heavily student tenancy. With the uncertainty about Columbia and City College, Barnard, you're seeing a pretty significant vacancy increase right now. You're also seeing, with the rents dropping, really all over the city, but certainly in the better parts of the city, more significantly or equally as significantly. You're seeing people go further south, where they could afford an apartment, 20 blocks south that they couldn't have afforded maybe 6 months ago.
Yes.
And I think that's interesting to me. I think you're seeing people having the opportunity to live in neighborhoods where they didn't previously have that opportunity.
Yeah, that's a great point. We're seeing that happen all over the city. Is that basically the tenants that are looking to rent right now are they're upgrading their location, and in some cases the quality of their apartment for the same price, right? So, but you bring up a good point that the Upper Manhattan market really has several different kind of tenant markets in there. We were talking a second ago about you've got the student population, and then you have the young professional population that may be in a stabilized unit. You also have the young professional population that may be in a free market unit. So, what are some distinctions that you're seeing, Jake, relative to what we were just talking about?
Yeah, look, I think like Seth said, there are challenges uptown that, the rest of the market is facing. However, uptown specifically, because you have such a diverse tenant population, not only are you battling vacancy, but you're also battling a collection problem.
Mm-hmm. So you have situations where you have free market units that may be going to young professionals. That market is a little bit in flux right now, but you're starting to see some of that backfill from the students.
Yes, absolutely. We are working on an assignment up by Columbia, and 45 days ago there were 0 vacancies. The buildings are almost entirely populated by young professionals and or students.
Mm-hmm.
We're getting what we believe is fairly close to a deal here. And yesterday, the buyer went to tour the buildings and said, "Did you guys know there are 6 vacancies?" We didn't know there were 6 vacancies. And following after our call, we had reached out to the owner, and the owner said, "Well, there were 6 vacancies, but I've already released 3 or 4 of them." So, I think that's a very, very strong sign, for the market up there, and should give owners out there, a lot of hope as to what's to come in the coming months regarding rentals and, releasing apartments.
Well, in that case, right, it was young professionals that may have vacated those units because they are uncertain about when they're coming back and all that kind of stuff. But those units were taken by students, right?
Absolutely.
Right. And students have their own set of uncertainty about, in person and all that type of stuff, and that'll affect other businesses. What are you seeing that's going through in the mindset of the owners in Upper Manhattan, Haley?
I think the psychological perspective is pretty interesting because we were operating in such an extreme vacuum in March, and people just couldn't get their minds around selling. So there's been a major shift from fear to now selling isn't a defeat. And I think the ownership side is really starting to understand how they're looking at their buildings, what their return on equity is. And there's a lot of organization and anticipation on the forefront of their investment decisions. now. So
Right.
people are thinking more pragmatically and like with common sense and logic versus just emotions.
Yes.
Um,
Yeah.
where the
Like,
market was in March.
right. When the market shifts, you immediately, like, you grab the table and you don't want to do anything. And now
Exactly.
it's more, okay, well, what's the best
Yeah.
decision? I think what are you noticing? We've had several deals that we are either working on or I've gone under contract or closed. Since this all started, Jake, like, what are you noticing as some of the commonalities of who are the owners that are actually selling?
The common denominator amongst 90% of the sales buildings we're currently selling and or have put in contract are that these buildings have been owned by the same individual or family for a tremendous amount of time,
Mm-hmm.
at least upwards of 20 years, and in one specific instance, over 100 years. And what Haley was saying,
Hopefully that's several family members.
yeah, several family members, 108 years. And, at this point in time, many of these sellers have decided that I still have a tremendous amount of equity, trapped in my building. And, now is the right time for me to sell.
And
I
why
can
are they
still,
selling? Where are they going to go with that equity? Seth, where are you seeing people go and replace it?
One of two things. The smaller private clients are going back to triple net leases. That business is still very much in play. There were some disruptions, just like anything else, but they're still going in that direction. The more sophisticated clients who are looking to grow their portfolio, they're not looking to shut down their business or retire. They're looking and exchanging into other parts of the country, so
Mhm.
other markets, whether it's Florida or Texas, but
Other property types.
other property types, garden style apartments without rent regulation, even if it's just replacing their cash flow, really just making their lives significantly easier.
Where do you think the point is? This is a theme. You hear a lot of lip service about this of, oh, I'm going to go buy out of town and stuff like that. And if you look at some of the cap rates for some of the hottest markets around the country, those cap rates now are 100 basis points lower than what you can buy something in New York for. So where do you think the market is before people start saying, hey, prices have fallen enough in New York that maybe I should come back and start buying again?
Good question.
Am I asking you a question that can't be answered?
I don't know if you could answer it. I think it's going to be different for everyone, but I think the barrier to entry in New York is harder than it's ever been, for a few reasons. Number one, the politics here make it difficult. So people that are, from outside New York that have maybe more of a business friendly political environment are looking in New York as as a challenge.
Yeah.
That's number one.
Is China or Russia, right? But we are getting a new mayor. We don't know who it'll be, but it's about 16 months from now, there is a new mayor that's coming in, right? So is that being brought up to you from the buying community, Haley, about this subject? Like, are you starting to see people start to look at the future, or is it still all reacting from the buying side?
I'd say 95% of my conversations are very politically charged, and the writing on the wall is definitely there, and people are, underwriting politics into buildings, and they're looking at the city, the election, pending good cause eviction, how ownership is vilified. So all of these things are coming into the equation. And people are scared, but I do think that there's definitely opportunity here. And like Jake said, private families have a 7 to 10 year outlook, and they got kids to pass these buildings on to.
Yeah. Well, Jake, when you were saying that, it just made me think of the concept of time, and that, you talked about the people who are selling and they have owned the buildings for a long time, and talk a little bit about the people who are buying today, because I think all the people that you're seeing tour and make bids and who have closed, since this is all happening, they have a particular outlook on time that's similar to those who are selling.
sure, yeah, absolutely. So many of the people who are buying buildings from us at this point in time, have been in the market for at least a decade and in some cases 40 years and have built up, pretty substantial portfolios. They've seen New York go up and down, and, they're totally comfortable with where New York is headed in the future. And at the same time are able to take advantage of historically low interest rates with their, substantial portfolio, using their buildings to go out and essentially buy more buildings.
Is it long-term, or are they looking at this as more of a short-term disruption that may yield appreciation or yield benefits in the short term? Or the buyers, are they like, when they're underwriting a building today, how long is a typical buyer's hold period?
Yeah, so the buyers over the last few years have totally shifted their timeline and their outlook. Like Haley said, I'd say it's at least 7 to 10 years. And with that being said, they look at what's going on right now in the city as a short-term disruption that they may stand to possibly take advantage of.
Yeah. Well, that's great. Seth, just touch upon the last thing regarding transactions in Upper Manhattan. How's the financing world impacting our deals today?
The lenders have tightened the screws on the underwriting. Like I said earlier, I think they're increasing their expense load and giving themselves a little bit more of a cushion. They're factoring in, more 5 or 6% vacancy and collection loss, whereas pre-COVID maybe it was like 3%. So they're giving themselves a little bit more of a cushion. It's funny, the appraisers, there's a lot of confusion in the market and misinformation, and the appraisers we're hearing are going back to the lenders sort of unsure as to how to value the properties. So I think, over the next couple of months, as more comps hit public record, you're going to see a little bit more transaction velocity open up, because there's just more data out there about, okay, what is the market?
Right.
And that's what I think has been confusing for a lot of people over the past few months. What is the market? Is there a market? How do you value it?
You got to agree on what a cash flow is. Is the building occupied? And the lender can't underwrite unless they have that type of data, and the buyer and seller. That to me, that's the biggest thing about buyer and seller's expectations, is that if you can't agree on what a building's makes this year, what it's going to make next year, there's no way your pricing expectations are going to be in line, because you're really looking at two different realities. So
So everyone, a lot of people say like, oh, well, what was the cap rate on that deal? What's the cap rate? Is it a 5, 6? What is it? Well, on my numbers, it's a 5. That maybe on your numbers it's a 4, maybe it's a 6.
Right.
It just depends on how are you getting to your NOI?
Yeah, right.
And
Haley, you're going to say something?
That's changing.
Seth took the words out of my mouth. I was going to say, all week long buyers are like, what even is an NOI? Like, I'm buying on a price per foot or a price per pound, because an NOI means nothing. And these rents, even if I'm collecting them this month, I'm not collecting them in December.
Right.
So,
the uncertainty. Right.
Yeah.
Yeah. So the question that we're seeing people ask themselves is, how long am I willing to leave my equity where it is, rather than doing something else with it? Because your cash flow in these stabilized markets is fixed. The government is telling you that you can't raise the top line. So if you can't raise the top line, you really better be able to control the bottom line. And that means controlling the expenses. And so if you have $5 million of equity in a building today, that's not really going anywhere. That's not changing. That's not going to 6 or 7 unless there's a policy change.
Unless we have policy change. So the question is, am I happy with the $5 million sitting there for the next 5 or 6 years? That's my equity amount. Or am I better served doing something else with that equity? Because the price change has already occurred. If I invested it somewhere else, do I have a better chance of that equity in 5 years being worth 7 or 8 or 9 or producing a higher cash flow? Is that what you're seeing on the ground?
Yeah, people are, the wheels are turning. It's very apparent that the wheels are turning, and this is something that most people haven't experienced before. You know, it's New York, and everyone says, oh, like the market just goes up and up and up, and the rents go up. And, you know, aside from some little blips, like over a long period of time, like generally it's New York and it goes up. But I think now people are looking at this differently than they have in years past, where this doesn't look like it's going to change in the near future. And so people are, you know, really going back to the drawing board and figuring out what they want to be doing with their equity. Are they happy with the cash flow? If you combine the cash flow and the management and look at that with what your equity is, are you happy with that? Mm-hmm. And are you happy with that over a long period of time, or is it time to consider something different? And those are the questions that people are, you know, weighing in their head. And, you know, some people are taking action.
That's a great point.
So I think that's question one. I think question two is, you know, an even bigger and more important question. And that is, if my NOI is going down every year, and it goes down every year, $10,000, $15,000, $20,000 for 4, 5, 6 years. It's when you get down the road that you really start to see a loss in value, right? Because that NOI loss is going to compound itself. And over time, you know, we're talking about a seven-figure, you know, dollar loss in value.
Well, $50,000 at a 5 cap is $1 million in value. So the other side of that is that if your taxes go up by $50,000, that's $1 million, you know, swing in value. So all of these things are tied in. So, well, Haley, Jake, Seth, thanks for joining, and we'll be back in another several weeks with another update on Upper Manhattan.